The UK government just released a new study on landlords, and the numbers are shocking. 93% of landlords are following an outdated model that's costing them thousands in tax and other avoidable expenses. 55% own just one property. And the brutal truth is, that strategy simply doesn't work anymore. If you follow the old school way of investing, you're effectively losing money. But there is another way. In fact, the top 7% of landlords are using a completely different strategy, and they're the ones making real money. So in this video, I'll show you why the traditional model is failing, the perfect storm that's making it even worse, and the new steps you need to take if you want to build lasting wealth through property. To help you avoid this trap, let's look at how things used to work in a little more detail. Say we have a couple, let's call them Joe and Susie. And when Joe and Susie decided to move in together 20 years ago, they already owned a property each. So instead of putting one of them on the market, they thought, let's rent this one out and use the money to pay both mortgages. And that's exactly what they did. And after covering their mortgages, they even had some cash left over for other living costs. Sounds like a smart move, and 20 years ago, it was. But what many people don't realise when they go down this path today is that the rules have changed. And being an investor of one isn't quite as profitable as it used to be, even though research shows that the majority of landlords are still doing exactly this. They're still renting out their first property to pay for their second, or maybe holding on to one house that they inherited. But here's the problem. The data shows that most accidental landlords aren't making much money at all. Over half of UK landlords earn less than £10,000 in profit each year. And even those who built up a few properties are working harder and harder and taking on more risk, only to have relatively little to show for it. Because since 2016, tax reforms have eaten away at landlords' profits. The 5% stamp duty surcharge adds thousands to your upfront costs. And if you only own one property in your personal name, you're dangerously exposed. As you'll see in a moment, these tax changes are just the start. There's an even bigger storm brewing. So let's say you own one rental flat in your own name, and for years it's ticked along fine. But then one day your tenant loses their job and falls behind on rent. A few months go by, they're still looking for work, and you're struggling to keep up with the costs. You need the property back because you can't keep covering the mortgage and other costs indefinitely, only to discover that under the new renters reform rules, you can't just rely on a no-fault eviction anymore, which means you have to go to court and the case drags on for months. Courts are backlogged, legal fees pile up, and all the while you're having to keep on top of the mortgage payments, service charges, and insurance costs. Suddenly, an investment you thought would be easy money is draining cash out of your pocket. The problem is, you have a massive concentration of risk. When you're operating at such a small scale, one long void period or one problem tenant can completely wipe out your profit for the year or longer. Now layer on top the rising cost of borrowing, tighter regulations about energy efficiency, and increasing political pressure, and you've got the perfect storm. The risks are rising, the costs are rising, but the returns for small-scale landlords, they're not moving. That's why if you're still treating property like a side hustle or as a hobby, you're leaving yourself wide open. Because the new reality is that being casual about investing isn't just outdated, it's dangerous. So if the old model is broken, what are the smartest investors doing instead? Well, they aren't chasing complicated strategies or exotic deals. They're just playing by a new set of rules that most small landlords still haven't caught on to. And the first one involves structure. For years, most people bought property in their own name, and as we've seen, the returns you can make under that model have been eroded by tax changes. Company landlords, though, don't have the same problem. They're building tax-efficient and profitable portfolios without working themselves into the ground. This is why professional investors are building their portfolios almost entirely as limited companies, because it puts them back in control. In a company structure, you can still deduct mortgage interest as an expense. You pay corporate tax at a lower rate, not at higher personal income tax bands. And it gives you far more flexibility when it comes to passing on your portfolio. That's why studies show that around 75% of investors buying today do so through a company. That doesn't mean it's right for absolutely everyone. You should always take tax advice that considers your full circumstances. But we frequently hear from investors who've just bought in their own name, then found out that they've made a mistake. Because they've realised that if you're still buying in your personal name, you're already at a disadvantage. By the way, if you want to avoid this and every other property mistake, download our free toolkit where we guide you through the different tax structures and share several resources to help you make property work for you. You'll find the link in the description. The second rule involves debt. Because I often hear from small landlords who are terrified of it. They think that taking on mortgages to buy property as an investment is too risky, and it just makes everything harder. But the professionals see it differently. Imagine you invest £100,000 of your own money into a property worth £300,000. So the other £200,000 comes from the bank. Now, if the property grows in value by just 3% in a year, that's £9,000 of capital growth. That £9,000 was generated by the full value of the property, but the money that you put in was £100,000. So your actual return on cash from that 3% growth is 9%. And that's before you even count the rent coming in. This isn't even relying on any kind of property boom. You'd expect inflation alone to run at around 3% a year. So while inflation eats away at people's cash savings, for property investors, it's a good thing because it slowly erodes the real cost of your debt. Meaning the longer you hold, the more the balance tilts in your favour. And the third rule is scale. Owning one rental is like running a shop that only sells a single product. One hiccup and your whole business stalls. That's why the smart investors aim for 3 or 4 properties at a minimum. That doesn't mean you have to start there. Hardly anyone does. You just have to have the aim to get there and a credible plan to do it. At that point, you spread risk, benefit from economies of scale, and can run things like a business instead of a side hustle. These 3 changes, structure, leverage, and scale, are the reason the top 7% of landlords are thriving while the rest are struggling. So what does this mean for you? Because you're probably sitting there thinking, okay, Rob, this sounds great, but I can't afford to just snap up 7 properties tomorrow. And I get that, but there are things that you can do today that over time can move you closer to the professionals. You don't have to go from one-man band to property empire overnight. So what are the key steps? Well, step 1 is you need to structure things properly. Before buying anything, take tax advice. These things are often expensive to fix down the line, so get it right from the start before you invest any more of your money. Then we have step 2. Use leverage to your advantage. As tempting as it can be to pay off your mortgage as soon as it's possible, try to make the mental shift of seeing it as a tool rather than a burden. Over time, inflation will reduce your debt as a proportion of the property's value without you rushing to make overpayments. We've already seen how it can turn normal 3% inflation into a 9% annual return even before the rent comes in. Inflation is the single biggest advantage that property has over other assets, so it makes sense to take advantage of it. And lastly, step 3, buy properties that can run themselves. Sarah Beanie and George Clark make big renovation projects look satisfying, easy, and profitable. But fixer-uppers can be high-drama money pits, even for those who know what they're doing. Thankfully, you don't have to buy a Victorian cottage with holes in the roof to turn a profit. In fact, the smartest investors often play it safe, buying quality homes in strong rental areas and just renting them out. By focusing on properties that can effectively run themselves, you'll have more time, energy, and money for everything else. And you'll be setting yourself up to be in the top 7% who are still winning, while everyone else complains that property investing is broken. So yes, property investing is broken if you follow the old model. But if you treat it like a serious business, use company structures and apply leverage intelligently, it can still transform your wealth. But even with the right strategy, most investors still trip up somewhere. In fact, we've identified the 7 biggest mistakes that still catch out even seasoned property investors. So watch this next video where I break them down so you don't make the same expensive errors.